So I think we've had a default, and I think what we're now in is a rolling scenario of what happens when you have a default. And that is why I see silver now in the cash market running relentlessly higher again.
Yeah, it's up a lot today. Last I looked, let's see, the futures price right now is 53.42, up $2.67 or 5.27%. And if you followed the guys in GATA, Bill Murphy, Chris Paul, there was a 2% rule my whole career. Like it never goes higher than 2% in a day. We're up 5.5 right now.
Yeah. So
that
I think
would support what you're saying.
Yeah, I think London, essentially, the London silver and gold market is a smoking hole right now.
Over the last year, the precious metals complex has repeatedly signaled structural stress beneath the surface calm of published prices. That stress is not theoretical. It shows up in lease rates, in episodes of pronounced backwardation, and in delivery frictions within the London market that simply cannot be explained away by normal trading cycles. In this conversation, Andy Schectman and David Jensen walk us through concrete market mechanics, the differences between London's cash market and New York futures, the peculiarities of forward generation in the LBMA system, and the narrowness of available non-ETF metal. And they do so from the vantage point of people who live with delivery and storage every day. Those mechanics matter because they determine whether price moves are purely paper adjustments or signs of an underlying physical squeeze. David Jensen speaks from long experience in the mining and physical metals sectors, focused on where real metal exists, how it moves, and how contractual structures translate into deliverability. He stresses that London is the primary global venue for physical silver price discovery, the reference point used by most mining contracts and commercial settlements that makes London's operational health a systemically important variable. When the market that sets the daily cash price begins to show persistent backwardation and delivery delays, those are not transient anomalies. They are operational red flags that change how producers, consumers, and large holders behave. Schectman and Jensen highlight specific signals investors should watch. Persistent backwardation where spot exceeds futures, spike-level implied lease rates, evidence of exhausted free float after ETF inventories are excluded, and sudden, meaningful injections of metal into London vaults that relieve pressure only temporarily. Taken together, these signals point to a market where paper claims, the notional ounces showing up on trading screens, increasingly outstrip the physical ounces immediately available to satisfy delivery. For investors thinking in months and years rather than hours, that asymmetry is a structural tailwind for both gold and silver, with silver especially exposed because of its smaller industrial to monetary float and its current demand profile. Importantly, Jensen frames this as more than a technical curiosity. It is an operational mismatch that can create episodes of acute price discovery when participants are forced to take delivery rather than settle paper positions. If the market has, in effect, experienced a default, even a localized or rolling one, the route to price discovery is through the cash market and the physical players who must secure metal now. For investors who have long viewed precious metals as monetary insurance, the implications are straightforward. Scarcity risk in the physical market amplifies upside for those holding allocated, deliverable metal. Before we dive in, please like the video, subscribe for future deep dives, and leave a comment below. We appreciate the support and hope you enjoy the video.
Is the COMEX and the LBMA two sides of the same system, or does one ultimately depend on the other for price control and stability? I guess would be my first question. A lot of people ask me that.
Yeah, well, I mean, when London's closed, you can materially move the price of gold and silver with the futures market in New York. It does influence the spot market, or has historically. It's becoming less important now that we've got true shortage in the market, and we see the spot price, the cash price for gold and silver, or for silver, is above the futures price, the December's futures price still. This is even after an injection of 50 million plus ounces in the last month back into London after their available metal ran dry in that market. So, and that to me is the crucial thing. Is we had visibility in October of a market basically pausing or stopping into a forced stoppage because of lack of silver liquidity offered into the market. So So New York is a hedging market. It's a futures market. London does offer forwards, but more than 90% of the trading there is in the cash or the spot market for immediate ownership and immediate delivery. And even the forwards that they offer there require you to acquire a spot contract in order to create a forward. So if they say, well, we have some forward trading here, and say, yeah, but those contracts are all based on a spot contract as well.
Right. Now, you've described the LBMA as being structurally fragile. And you just mentioned that the market where the spot price is higher than the futures price, this is called backwardation, and something that we saw to an extreme level a few weeks ago.
Yeah.
And then, as you mentioned, the infusion of 50 million ounces, kind of a lifeline, took care of that. But here we see a slight increase in backwardation again. Yeah. In your view, the backwardation, along with perhaps maybe you can discuss the unallocated positions and the overwhelming volume of paper, gold versus silver versus physical, explain what are the key points of failure that you see, maybe starting with the backwardation.
Yeah, well, we did see on October 10th, the market seize up in London. And that is despite the fact that they had roughly 790 million ounces in the vaults in London. But of that 790 million ounces, approximately 650 were held by exchange traded funds, so it should not be offered into the market. And the remainder, which was approximately 140 million ounces, was not offered to market. So what we got there, Andy, was on that day, we caught a glimpse of where the bottom of the barrel was. And the London market actually bounced into that bottom of the barrel. So even with 140 million ounces not held by the ETFs, there was no silver liquidity in London. So we know that market is tapped out circa 140 million ounces of non-ETF gold. So with the addition of, notionally with the addition of 54 million ounces to that market, they've got a little bit of liquidity. LBMA now in their statistics state that they're trading on an active day, they're trading more than 700 million ounces of silver every day in the cash immediate delivery market, immediate ownership and immediate delivery market. So if you've got 50 million ounces, but you're trading 700 million ounces a day in these cash contracts, and that speaks of an open interest or total claims in the market of at least a couple billion ounces, you can see how weak this market is, and that the market has actually failed. It's just a matter of the London market has failed. It's a matter of it, silver purchasers recognizing this. And I think what we're seeing today with these 4+% price moves after the price had come off 10-15% here a couple of weeks ago, is that investors and purchasers are stepping in to acquire what little silver is left in that market. London right now operates on a silver in, silver out basis. If they get silver, they can deliver some silver. If they don't get any, they are unable to deliver silver. And we saw that from that signal. They've got a 50 million ounce buffer right now, but they are dependent on continual deliveries of silver to meet delivery demand from these cash contract holders.
Yeah, I cite your information regularly. And when we talk about the LBMA, they, for a good portion of the year, it's a T+1 exchange. T for the trade day, +1 to settle on the third day. Those bars should be moving.
Yep.
But as you know, it was 8 weeks because we were told the Bank of England had a shortage of manpower and trucks. And I cite your figures regularly in the respect that, you say there's roughly 2 billion ounces of deliverable contracts out there against a 140 million ounce float. What could possibly go wrong? Or trading 700 or 800 million ounces a day in deliverable contracts against a 140 million ounce float. What could go wrong? Or even Bruce, I forget his last name, Ikamoto. I'm sorry, yeah. Bruce. He talks about 3 million ounces of platinum traded every day with 0 platinum in the vaults. What could go wrong? My question to you that I think is paramount to your analysis is, how confident are you in the LBMA's reported trading volumes and inventory figures? Kind of the same way I wonder, the CME group, how accurate are their figures on the commitment to traders report, but how confident are you in the LBMA's reported volumes in trading and in inventory figures?
That's a good question. It's very difficult to say. You're dependent on these the banks, which have on numerous occasions shown themselves feeling free to operate outside the law. Number one.
Yeah.
But I mean, in 2013, the LBMA was indicating that they were trading about 2.5 billion ounces of silver a day in the cash market. 2.5 billion in a world where you're producing 800 million ounces a year. Now suddenly that number has dropped to around 700 million ounces a day. So we really don't know. It's an opaque market run by banks which have been charged with fraud on numerous occasions. So we really don't know. But you know, the idea that the 140 million ounces is a float, I mean, that's the amount of silver not held by ETFs. But if you want to talk about a free float, what is available to London when you're at the 140 million ounce level right now, the free float is zero.
It's the 55 million ounces that they got injected in there.
Right after that. So we've got about 50, and we don't even know of that 50 million ounces, how much of that is held by private investors who are willing to deal that into the market. We do know the benchmark on October 10, there was 140 million ounces in the vaults not owned by ETFs, and that the free float on October 10 was roughly zero.
Picking up from their exchange on market mechanics, an immediate practical consequence is that hedging platforms and commercial counterparties behave differently when deliverability is uncertain. On COMEX, rules permit forced cash settlement in certain circumstances, and the futures market has historically been capable of moving the paper price. By contrast, London's privately negotiated spot contracts are governed by contract law and require real movement of metal to satisfy claims. Jensen emphasizes that when a cash market that normally clears on immediate delivery cannot source metal, the composition of supply changes. Metal that would have circulated as leasable inventory is hoarded or reclassified, and previously latent demand, from industry, from strategic buyers, from bullion houses, becomes explicit. That conversion of latent to explicit demand is a decisive driver of price appreciation. The recent injections of metal into London, while important in preventing an immediate market seizure, are not, in Jensen's view, a long-term solution. They serve as temporary buffers that buy time, but do not restore a durable free float if the structural imbalance remains. Smart money responds to that imbalance by accelerating accumulation of allocated physical, widening the gap between available deliverable ounces and outstanding claims. For investors, the takeaway is procedural and tactical: allocation to metal that is immediately deliverable, held outside of pooled or unallocated positions, materially reduces counterparty exposure and captures the premium that physical scarcity can impose.
So if you were inside of a major bullion bank or central bank today as an advisor, what's the one thing that you'd be most worried about when it comes to the LBMA's future? And as an aside, to your last point, do you see any signs that perhaps key institutions are quietly preparing for a breakdown or a shift in the system?
If we've got of the order of, let's say, 2 billion ounces of claims in the market, and we have $100 price move up in the price of silver, if those claims have been underwritten, offered into the market by the banks, $100 move in the price of silver translates to a $200 billion liability, and that gets quite messy quite quickly on a bank balance sheet. So that would be the biggest concern is the I can kind of see it in a lot of the commentary which is being written on the bullion banks is, we're relieved now that the price of silver has run higher, and now we're going to see more silver come into the market, and that's the end of the run. That's the end of the squeeze. And I think we're at a very nascent stage of this, at the beginning of it, not in the middle or not near the end of it. And so I think the crucial thing here is that users of the metal, and a nuclear power plant, just to build one takes 5 million ounces of silver. We know there's a big push for energy, but I think the biggest role of silver and gold are as monetary assets and safe haven assets. And I think that this is what is going to get out of hand here quite quickly for the bullion banks, is that they've they've sold promises into the market that they can't possibly keep.
Before you answer the second part of any institutions quietly preparing for a breakdown, maybe shifting their exposure, do you think that a failure to delivery is possible? And have you ever run that out? Like if a major bank, Standard Chartered or Deutsche Bank or whatever, were to have a failure to deliver, could that also possibly create a far greater, let's say, contagion, if you will, because these banks are not just bullion banks, they also have their finger in the pie of everything, a massive breakdown in trust.
Yeah.
Do you see that as being possible, the start of something that kind of breaks the system?
Well, I think the implied lease rate for silver a couple of weeks ago hit 39%.
Yeah.
And the implication there is that we did have a default, because you could be sure the actual lease rate would be higher than that. So I think we've had a default, and I think what we're now in is a rolling scenario of what happens when you have a default. And that is why I see silver now in the cash market running relentlessly higher again.
Yeah, it's up a lot today. Last I looked, let's see, the futures price right now is 53.42, up $2.67 or 5.27%. And if you followed the guys in GATA, Bill Murphy, Chris Paul, there was a 2% rule my whole career. Like it never goes higher than 2% in a day. We're up 5.5 right now.
Yeah. So
that
I think
would support what you're saying.
Yeah, I think London, essentially the London silver and gold market is a smoking hole right now. And what we see is acquirers, the industry especially that absolutely needs the metal, are stepping in and trying to acquire the metal as they can. And I don't think this process is going to take too long. I think we had a default. The lease rates were telling us that somebody couldn't get metal, the implied lease rate. I don't know what the actual lease rates were, but I suggest they would be materially higher than that. And that what we see right now is a pause for a couple of weeks. 50 million ounces come from China and New York and Switzerland to kind of give a little bit of a patchwork covering to what is going on in London, but that we are now in a rolling failure of the London market. Let me put it that way.
Do you see any of them preparing for this breakdown? Do you see it even slightly, or any rumblings of it, or any clues, perhaps?
I think we would be the last to know, because that's something that, let's put it this way, if you were a bullion banker and you were breaking ranks, it's something that could get you some negative attention from your compatriots.
Right.
So very difficult to say. If you look at game theory, it's likely happening in subtle ways. But we're talking about some very big players. And if you're talking about a position of 2 billion ounces sold into a market where the metal does not exist to deliver it, and all of a sudden in the last 4 weeks, we've gotten visibility of exactly how little metal is available in that market, I think that things are going to become very, very active here going forward. Now, who the exact players are and what they're doing is very tough to tell. And I think that the individual players would do the best that they could not to let us know what that is. But I think the price action, the fact that the lease rate hasn't gone below 5%, we've still got price backwardation where the spot price is higher than the forwards and the futures. This is very much in action. I think we're going to see a parsing up of the 50 million ounces, and then the next stage, where's the next 50 going to come from?
Right.
The next 50 is going to become very much tougher than the prior 50.
Looking forward, there are three interlocking dynamics that determine how large the upside can be and how rapidly it might accrue. The first is the evolution of deliverability, whether bullion banks and custodians can continue to source incremental metal at scale and frequency, or whether each patch becomes progressively harder to replicate. The second is demand composition, industrial and strategic requirements for silver, including electronics, solar, and other sectors, add a consumption floor that reduces the elastic supply otherwise available to paper markets. The third is market psychology. Once a market acknowledges structural scarcity, behavior changes in ways that reinforce the scarcity: longer holding periods, less willingness to lease or lend, and higher bid-side aggression. Jensen's assessment that we have already seen a default, followed by a rolling series of stresses, is important because defaults reallocate risk in ways that are not simply linear. A modest, temporary price move will not necessarily reverse if counterparties reprice counterparty, delivery, and settlement risk into bids for physical metal. That repricing is what converts technical backwardation and high implied lease rates into persistent price elevation. It also means that futures or forwards may lag the true cash price for a prolonged period, a condition that favors holders of allocated, immediately deliverable metal and producers with secure offtakes. Finally, consider that precious metals operate at the intersection of monetary, industrial, and geopolitical forces. Central bank behavior, currency dynamics, and strategic national reserves all influence the supply and demand calculus for gold and silver. Jensen's warning about structural fragility is therefore not a niche technical observation. It is a macro-relevant signal that can amplify broader flows into monetary assets. For investors who respect capital preservation and asymmetric upside, the current environment merits disciplined allocation to physical metal and close monitoring of the operational indicators that Jensen and Schectman unpack in the interview. If you found this helpful, please like, subscribe, and ring the bell for more data-driven coverage of precious metals markets. Tell us in the comments which indicator you want tracked weekly: lease rates, backwardation, vault flows, or ETF inventories, and we'll prioritize the most requested. Thanks for watching.